Everyone's obsessed with trying to call the top of the crypto cycle. Most of the time, it's pure guesswork. But what if October could actually be different? In today's video, I'll break down why October could mark the next local top for crypto using Fibonacci targets, Fed rate cuts, and global money supply.
Chris Berniski, a partner at Placeholder VC and one of the sharpest minds in crypto, recently set the market abuzz with some incredibly bold October price targets. Known for his data-driven analysis as the former crypto lead at ARK Invest, he's projecting Bitcoin to reach a staggering $142,000. For Ethereum, he sees a range between $6,900 and $8,000, and for Solana, a target of around $420. It's easy to dismiss these as moonboy predictions, but Berniski's thesis is rooted in a tool used by traders for decades: Fibonacci analysis. The Fibonacci sequence is a series of numbers that appears throughout nature, from the spiral of a galaxy to the petals on a flower. Traders believe these same mathematical ratios govern market psychology, creating invisible lines of support and resistance. It becomes a self-fulfilling prophecy as millions of traders watch and react to the same key levels. When we apply this to the charts, the picture becomes clearer. For Bitcoin, a key Fibonacci extension level, the 2.618, which often marks the peak of a powerful bull market wave, sits around $154,000. Berniski's target is right in that technical ballpark. Similarly, Ethereum's 2.618 extension target lands squarely around $7,000, aligning perfectly with his forecast. These aren't random numbers. They are calculated destinations based on past market structure, but technicals alone don't move markets. This setup is supercharged by the macroeconomic backdrop. The Federal Reserve is widely expected to begin cutting interest rates in September, with markets pricing in an over 80% probability of a cut. Lower rates mean cheaper money, injecting liquidity into the system. Historically, this easy money environment has been rocket fuel for risk assets like crypto. This potential flood of capital is the powerful tailwind that could propel the market toward those ambitious Fibonacci targets. Let's start with the single biggest pile of cash on the planet right now: an unprecedented $7.2 trillion sitting in U.S. money market funds. This isn't just idle money. It's a direct consequence of the Federal Reserve's aggressive war on inflation. As interest rates soared, investors flocked to the safety and attractive yields of these funds. But that era is coming to an end. With inflation showing signs of cooling, the market is already anticipating a pivot from the Fed towards rate cuts. When that happens, the yields on these safe havens will plummet, forcing a great rotation of capital. Investors will be compelled to move out on the risk curve to find returns, and a significant portion of that capital will look towards high-growth, high-risk assets like cryptocurrency. This is the dry powder that could fuel the next parabolic run. The first tremor of this shift is already visible. Bitcoin dominance just broke below 60% for the first time in years. For the uninitiated, Bitcoin dominance measures Bitcoin's market share of the entire crypto space. Historically, it's a powerful sentiment gauge. When dominance is high, fear rules the market, and investors huddle in the perceived safety of Bitcoin. When it falls, it signals a growing appetite for risk. The 60% level isn't arbitrary. It's a major psychological and technical support line. Breaking it suggests a fundamental change in market psychology, indicating that capital is preparing to rotate from the king of crypto into the broader altcoin market in search of exponential gains. However, there's a critical macro headwind we cannot ignore: the global M2 money supply. M2 is a broad measure of money in the system, and its expansion or contraction is a primary driver of asset prices. After hitting a record $21.9 trillion, fueled by pandemic-era stimulus, US M2 has seen its biggest decline in 7 months. This is monetary tightening in action. History shows us a clear correlation. Bitcoin's price action tends to lag behind changes in global M2 by about 2 to 3 months. This recent, sharp pullback in liquidity is a flashing warning sign. If the lag holds true, the crypto markets could face significant downward pressure, potentially finding a bottom in late September or early October. This creates a complex and delicate timing puzzle for investors. But here's the bullish counter-argument, and it's a powerful one. While macro liquidity is tightening, a new crypto-native liquidity spigot has just been turned on full blast. The spot Ethereum ETFs. These aren't just another financial product. They are a regulated, institutional-grade superhighway for capital. The inflows have already shattered records, proving that immense, previously untapped institutional demand for ETH is real. This is the smart money. Pension funds, asset managers, corporations, placing a massive bet on the ecosystem beyond Bitcoin. This institutional validation is the ultimate catalyst for what we call altcoin season. It legitimizes the entire asset class, creating a powerful narrative that will cascade down to other projects. As capital flows into ETH, investors will begin hunting for the next big thing in high-growth sectors like AI, real-world assets, and DePIN. The setup is clear: a wall of money on the sidelines, weakening Bitcoin dominance, and a new institutional gateway are converging to create the perfect storm for altcoins. Now, let's fast forward to our October scenario, a period that could be the sweet spot for a major local top. Historically, the fourth quarter, dubbed Uptober, has been incredibly bullish. If momentum from the Bitcoin halving and sustained ETF inflows continues to build, we could see a dramatic acceleration. Our models, factoring in Fibonacci extensions and strong on-chain holder data, suggest this isn't just wishful thinking. We're projecting Bitcoin to blast past the $150,000 mark. At the same time, Ethereum, fueled by its deflationary mechanics and a thriving Layer 2 ecosystem, could finally enter true price discovery, pushing well above $7,000. When the market leaders make such powerful moves, capital inevitably rotates into altcoins, igniting the real fireworks. This is where we could see Solana, supercharged by network upgrades like Fire Dancer and growing institutional interest, shatter its all-time high and target $400. But it won't be alone. Expect entire sectors to go parabolic: AI tokens, real-world assets, and yes, even the most speculative meme coins will likely experience face-melting rallies. The headlines will go wild, splashing across mainstream media. This is the definition of peak euphoria. And then, the market takes a giant breather. This won't be a gentle dip. It will be a violent correction, potentially a 30-40% drawdown in days. The market will be dangerously over-leveraged, and a slight downturn will trigger a cascade of liquidations, wiping out latecomers. That's the danger. A euphoric blow-off top followed by a sharp correction. This period of peak excitement is the golden window to lock in profits. The smartest investors don't try to time the exact top. That's a fool's errand. They have a predefined exit strategy, systematically securing gains. They understand that paper profits are meaningless until they are realized, securing profits along the way while staying in the game for the long run.
I don't believe October marks the end of the bull run, but it might be the perfect time to take some money off the table. Moments where Fibonacci, liquidity, and macro all point to the same conclusion don't come around often. The risk-reward of ignoring this setup is massive. Thanks for watching. Don't forget to subscribe for more crypto market breakdowns, and let's see how October plays out.